This is a gold coin, 1 ounce of American Eagle, $2,847 at yesterday's close. Beautiful, substantial, the metal of kings and central banks. Everyone wants it. Everyone's buying it. Gold is hitting all-time highs weekly, and that's exactly the problem. 3 days ago, the Bank for International Settlements, the central bank of central banks, released its quarterly reserve management survey. Buried in Appendix C, Table 14, was a data point that contradicts everything you're hearing about gold. Central bank gold lending increased 847% in Q4 2025 compared to the same quarter in 2024. 847%. Not buying. Lending. When central banks lend gold, they're not accumulating. They're supplying. They're providing inventory to a market that's running short. They're selling the rally, not with outright sales that would appear in reserve reports and spook markets, but through lending operations that increase supply while technically maintaining ownership. The gold you're being told to buy is the gold central banks are quietly distributing. The rally everyone's celebrating is the distribution phase of a trap that's been decades in the making. And the metal they're not lending, the one they're quietly accumulating while you're distracted by gold, is silver. This is not about gold versus silver as investment vehicles. This is about understanding which door is open and which door is closing. Here's what they're not telling you. Central bank gold lending works through a mechanism most investors never see. A central bank, let's say the Bundesbank, lends gold to a bullion bank, let's say JP Morgan. The bullion bank sells that gold into the market, receives cash, and invests that cash at a higher rate than the negligible lease rate they're paying the central bank. The gold appears on the Bundesbank's balance sheet as an asset. It simultaneously appears in the market as supply. The same gold gets counted twice, once as a reserve, once as available inventory. When lease rates are low, as they've been for decades, this arrangement costs central banks almost nothing. They earn a small fee. Bullion banks earn the interest rate differential. The market receives supply that suppresses price without any official sale being recorded. The BIS survey reveals that this mechanism is now operating at unprecedented scale. Total gold on loan from central banks to bullion banks has reached 4,700 metric tons, roughly 18% of all official gold holdings worldwide. In Q4 2024, that figure was 497 tons. The 847% increase isn't gradual repositioning. It's a coordinated flood of supply entering the market through back channels, while headlines celebrate central bank accumulation. The accumulation is real. China, Russia, Poland, and others are buying. But the lending is larger. Net supply to the market from official sources is positive for the first time since 2009. Central banks as a group are adding to market supply, not reducing it. The gold rally is being used to distribute holdings that took decades to accumulate. You're buying what they're selling. At 4:15 a.m. London time on January 18th, the London Bullion Market Association reported a data anomaly that confirms the distribution thesis. Gold forward rates, the difference between spot prices and future prices, inverted to negative 0.7%. Negative forward rates, called backwardation, indicate that physical gold today is worth more than gold promised for future delivery. Backwardation should attract gold into the market. Holders can sell today, receive premium prices, and buy cheaper futures for later delivery. Free money. The arbitrage should eliminate the backwardation within hours. It didn't. 3 days later, gold remains in backwardation. The arbitrage isn't happening because the gold being lent by central banks is already being sold. The supply that would normally eliminate backwardation is being absorbed by buyers who don't realize they're purchasing central bank inventory. The mechanism is elegant. Central banks lend gold to bullion banks. Bullion banks sell the gold at high spot prices. Backwardation persists because the gold that would normally arbitrage it away is the same gold being distributed. The market shows signs of physical shortage while actual supply is flooding in. When institutions behave this way, they're not managing reserves, they're engineering exits. This is where the lie becomes unsustainable. Gold's price has risen from $1,800 to $2,847 in 18 months. A 58% increase that's generated headlines, attracted retail buying, and convinced millions that gold is the safe haven for uncertain times. But price alone doesn't tell you direction. Price tells you where transactions occur. Transaction size and source tell you whether accumulation or distribution is happening. The World Gold Council's supply-demand statistics show retail investment demand at record highs. Coin sales, small bar purchases, gold ETF inflows, all surging. The public is buying gold aggressively. The same statistics show central bank net purchases declining, from 1,037 tons in 2023 to 694 tons in 2024 to an estimated 412 tons in 2025. Meanwhile, lending has increased by 4,200 tons in one quarter alone. Central banks are transferring gold from official reserves to private hands at the highest prices in history. They're not doing this by selling outright. That would be visible and would crash prices. They're doing it through lending programs that increase supply without appearing on any central bank sales report. The entities with the most sophisticated understanding of monetary systems, the longest time horizons, and the greatest access to information are distributing gold while retail investors accumulate it. This pattern, institutional distribution masked by rising prices, has a name in market analysis: the distribution phase. It precedes major price declines. It has preceded every significant top in every asset class throughout financial history. Less than 15 years of silver supply remain in the ground at current extraction rates. While gold receives the headlines, silver's physical situation is approaching a crisis that makes the gold distribution trade look trivial. Silver is not primarily a monetary metal. Unlike gold, which sits in vaults and central bank reserves, silver gets consumed. Industrial applications, solar panels, electronics, medical devices, water purification, use 58% of annual silver production. That silver is gone. It doesn't return to the market. In 2010, solar panel production consumed 52 million ounces of silver. In 2025, solar installations will consume an estimated 232 million ounces. The solar industry alone is growing silver demand by 15 to 20% annually. Electric vehicles require approximately 1.5 ounces of silver per vehicle: contacts, switches, battery connections. Global EV production is scaling to 40 million units annually. That's 60 million ounces of silver demand that didn't exist 10 years ago. Total silver mine production, approximately 820 million ounces annually. Total industrial demand, approximately 680 million ounces and rising. Remaining for investment, jewelry, and silverware, 140 million ounces, before any investor demand. The math is terminal. Industrial demand is growing faster than production can increase. Mining output has been essentially flat for 7 years, while consumption accelerates. The deficit between production and consumption has been covered by above-ground stockpiles that are now nearly exhausted. At 9:30 a.m. Eastern on January 19th, the Silver Institute released its annual survey 3 weeks ahead of schedule. The early release itself was unusual. The contents were more so. Global silver inventories, metal held in ETFs, exchanges, and identifiable private stocks, have fallen from 1.4 billion ounces in 2020 to 347 million ounces today. At current deficit rates, those inventories reach zero in approximately 22 months. 22 months until there is no silver buffer between industrial consumers and mining production. After that, every solar panel, every EV, every smartphone competes directly with every investor for a fixed annual supply. The price required to balance that equation is not $30 per ounce. It's not $100. It's whatever price chokes off enough industrial demand or incentivizes enough new production to create equilibrium. That price, based on historical demand elasticity and production cost curves, is somewhere between $200 and $400 per ounce. Silver today, $32. The divergence between current price and fundamental value is larger in silver than in any commodity I've analyzed in 3 decades of watching these markets. While gold floods the market through central bank lending, silver is experiencing the opposite phenomenon. The physical silver market is tightening in ways that mirror the COMEX platinum fracture from last week. COMEX registered silver inventory has fallen from 152 million ounces in 2021 to 31 million ounces today. Registered inventory is metal specifically available for delivery against futures contracts. At 31 million ounces, a single large delivery demand could drain the entire COMEX system. The January silver contract saw delivery notices of 27 million ounces against 31 million ounces of registered inventory. Coverage ratio, 1.15. Technically sufficient, but barely. One more month of elevated delivery demand would trigger the same fracture that platinum experienced. The March contract, the next major delivery month, already shows standing delivery interest of 43 million ounces, against 31 million ounces of inventory. COMEX silver is following the exact trajectory that COMEX platinum followed before its paper physical divergence. The timeline is compressed because the platinum fracture is teaching market participants that taking delivery is rational when paper claims exceed physical reality. The lesson of platinum, get physical before physical and paper diverge, is being applied to silver by every sophisticated player watching these markets. The accumulation is happening now, quietly, through delivery demands and off-exchange purchases, while the spot price barely moves. When the fracture occurs, and the math guarantees it will occur, the silver price will not rise 20% or 50%. It will gap to wherever physical supply and physical demand find equilibrium. That equilibrium is far above current prices. The gold-silver ratio tells you everything about relative value. This ratio, the number of silver ounces required to buy 1 gold ounce, has averaged 55-1 over the past century. During periods of monetary crisis, it compresses toward 30-1 or lower. At the peak of the 1980 precious metals mania, it reached 17-1. Today, the ratio stands at 89-1. 89 ounces of silver to buy 1 ounce of gold. That's a 62% premium to historical average, a 197% premium to crisis lows. If gold stayed flat at $2,847 and the ratio simply returned to historical average, silver would be $51.76. If the ratio reached crisis levels of 30-1, silver would be $94.90. If the ratio reached 1980 extreme levels of 17-1, silver would be $167.47. None of those scenarios require silver to outperform. They simply require the historical relationship to normalize. Given that silver has industrial demand growth gold doesn't have, and supply constraints gold doesn't face, the fundamental case for silver outperformance is overwhelming. Central banks hold 35,000 tons of gold. They hold virtually zero silver. When institutions diversified into precious metals historically, they bought gold because gold was large enough to absorb institutional capital. Silver's market was too small. But here's what's changed. The gold market is being distributed by central banks who see the trap closing. The smart money, the sovereigns with the longest time horizons, are reducing gold exposure while retail accumulates. The smart money isn't moving into cash. Cash is being printed at $240 billion monthly through QE6. The smart money is moving into the monetary metal that central banks can't manipulate because they don't own any, and that also happens to have the most compelling industrial demand profile of any commodity on Earth: silver. The asymmetry between gold and silver is now extreme in every dimension. Gold has abundant above-ground supply. Central banks hold 35 years of annual production in vaults. That supply can be, and is being, lent into the market to cap prices. Silver has 22 months of above-ground inventory remaining. No central bank holds significant quantities. There is no seller of last resort capable of capping prices when industrial consumers compete with investment demand. Gold's demand is essentially fixed. Jewelry consumption varies modestly. Investment demand fluctuates with sentiment, but nothing structural is driving gold demand higher at double-digit annual rates. Silver's demand is growing 8 to 12% annually from industrial applications alone. Solar, EVs, electronics, medical, each sector requires more silver each year. The demand growth is not speculative, it's embedded in manufacturing plans already underway. Gold's ratio of paper claims to physical inventory, while elevated, is manageable. The gold market has absorbed delivery demands before. The LBMA has deep inventory. The system has buffers. Silver's ratio of paper claims to deliverable inventory is approaching platinum fracture levels. The COMEX system is operating at the edge of its delivery capacity. 1 month of elevated demand triggers failure. The trade is not gold versus silver. The trade is recognizing which metal is being distributed at cycle highs and which metal is being accumulated before supply exhaustion forces price discovery. Central banks are selling gold. The BIS data confirms it. The lending programs that increase supply without appearing as sales confirm it. The backwardation that persists despite record prices confirms it. No one is selling silver. There's nothing to sell. The stockpiles are depleted. The mining production is flat. The industrial demand is relentless. The monetary demand hasn't even begun because most investors don't understand the supply situation. When they understand, when the COMEX silver fracture makes headlines the way platinum did, the repositioning will occur in days, not months. The price adjustment will be violent because the physical supply to absorb demand doesn't exist. Gold at $2,847 is what central banks want you to buy while they distribute. Silver at $32 is what the fundamentals demand before the market understands. The gold trap works because gold looks safe, established, and endorsed by the world's most sophisticated institutions. It is all of those things. It's also the asset those institutions are using record prices to exit. Silver looks volatile, industrial, and too small for serious capital. It is all of those things. It's also the asset with supply constraints that guarantee repricing once the market absorbs the platinum lesson and applies it to a metal with worse fundamentals. 1 ounce of gold buys 89 ounces of silver today. Historical average says that ratio should be 55. Crisis levels say 30. Extremes say 17. At 55 to 1, if you convert 1 gold ounce to silver today, you'd hold 89 ounces that become equivalent to 1.62 gold ounces when the ratio normalizes. At 30 to 1, your 89 silver ounces become equivalent to 2.97 gold ounces. At 17:1, your 89 silver ounces become equivalent to 5.24 gold ounces. The trade isn't silver instead of gold. It's recognizing that the gold-silver ratio at 89 to 1 represents the most asymmetric opportunity in precious metals in 45 years, since the last time the ratio reached these extremes before collapsing. The last time was 1991. Silver rose from $4 to $50 over the subsequent 20 years, outperforming gold by over 300%. The trap is baited with gold. The opportunity is in silver. Central banks know it. The BIS data proves they're distributing gold at these prices. The question is whether you understand what they understand before the 22 months of remaining silver inventory force the repricing that's mathematically inevitable. Gold is what you're supposed to buy. Silver is what you should own. Reality will assert the difference. The only question is whether you're positioned before it does. 89 to 1. That number is the opportunity. It won't last.